Hi everybody, we're going to work on problems together tonight in lieu of lecture. So you get to listen to this at your leisure. It's not my favorite way to do this class, but I had got called away to a recruiting trip to Blue Mountain, and so you get to listen to my lovely recorded voice instead of my live voice. So let's work some problems together tonight. So let's start with brief exercise 3.2. So you can turn to the end of your chapter and go look at what we're working on. So in this particular problem, we're going to be recording transactions in a journal. So since we know we're going to do that, let's go ahead and start with Alice, just so she's sitting beside us, because she's our new best friend, and that Alice tells us how to increase each account type. So this isn't going to be laid out the prettiest here, but we'll be able to get a general idea. So remember, assets are increased with a debit entry, liabilities with a credit entry, income or revenue, credit entry, capital or owner's equity, a debit entry, and expenses get a debit entry. So let's start on October 1st. So again, this is brief exercise 3.2. So on October 1st, we have a company called Quantum Clinic. So it looks like we have a medical clinic. We're going to issue 5,000 shares of capital stock to a Dr. Soges, and those shares are going to be worth $60 each. So $60 per share. So remember, I want you to analyze each accounting transaction first in your head, or you can write it down. But I want you to think about which accounts you're affecting and how you're affecting them. So in this particular problem, we're going to be affecting cash, aren't we? We're going to get cash in return for those shares. And we're going to be affecting capital stock. So cash is going to be increasing, right? So that's going to be our debit account. Capital stock is going to be increasing. Capital stock is part of the C in capital in Alice, so we know that that has to be our credit account. So let's do our journal entry. So see, what analyzing the transaction does is it gets you most of the way to the journal entry before you even start. So we know that we're going to be debiting cash for $60 times 5,000 shares, so $300,000. So we've taken care of our debit account. So let's do our credit account. Oops. That was kind of literal. So we know we're going to be crediting capital stock for $300,000. Let's go make that a little prettier here. There we go. So that is what our official journal entry looks like for issuing those 5,000 shares to Dr. Soges. So let's work on October 4th. So on October 4th, we are going to purchase diagnostic equipment. So the equipment cost us $250,000. And we're going to pay $100,000 in cash. And a note payable was issued for the remainder. So we're going to be dealing with more than two accounts here. So what's the first account we're going to deal with? Equipment. And so equipment's an asset, so we know that's going to be our debit account. So our next account we're going to use is cash. So is our cash increasing or decreasing? It's decreasing. So we know that cash is going to be a credit account. And note payable for the remainder of the amount. Note payable is a liability. We're increasing a liability, so that gets also a credit entry. So that's our other credit account. So this is going to be a compound journal entry that we've talked about before. So remember, we have to have at least one debit account because this is a double entry accounting system. We have to have at least one debit account, at least one credit account. We can have more accounts than that, but we have to have at least one of each. So on October 4th, it's going to be equipment. And our equipment is actually worth $250,000. So there's our first part of our journal entry. So now we can focus on our credit accounts. So cash, we're going to credit for $100,000. And the other account we're going to credit is a note payable. So we've accounted for $100,000 of that $250,000. So the remainder has to be $150,000. And we're going to credit that account for $150,000. So there's our compound journal entry. Okay. So let's move on to October 19th. Oh, actually, sorry, my stuff is messed up here. So October 12th. So on October 12th, we're going to issue a check for $6,000. And that's going to be in full payment of an account payable to Zeller Labs. Okay. So remember, a check is the same as cash in accounting. So we're going to consider that an asset. So that's the first account we're going to be dealing with. So cash is going to decrease. So therefore it is a credit entry. So that's our credit account. So our other account is an account payable. So that's a liability. We're going to be getting rid of that liability. So that's going to be our debit account. So let's do our journal entry. Let's clarify that it's Zeller Labs. And it was for $6,000. So we've taken care of that account payable with cash. So there's our credit entry. So our cash decreased and our accounts payable decreased. So let's move on to October 19th. So on October 19th, we're going to purchase surgical supplies. I'm going to do it for $4,000. And the payment isn't due until November 28th. So this is October. We're not paying until November. So that means we have incurred a liability. So it's a short-term thing, so that's going to be an account payable. And it's going to be for $4,000, and we're increasing an account payable, so that's going to be our credit account. Let's move this down a little bit so it's a little clearer. So our surgical supplies is our other account, that we're going to be affecting. Surgical supplies are an asset. We're increasing an asset, so that's going to be our debit account. So when we do our journal entry, we're going to debit surgical supplies for $4,000. And we're going to increase our accounts payable for $4,000. So hopefully by analyzing a transaction before you get started, you start getting pretty fast at these. That's the intent anyway. So on October 25th, we're going to collect an $80,000 account receivable from an insurance company. Okay, so we haven't dealt a whole lot with accounts receivable, but hopefully you're getting a good feel for it anyway. So if we collected an account receivable, we got cash because this was previously an amount that they owed us, had not paid it yet, therefore it was an account receivable. So cash is going to be our debit account. So our other account is going to be an accounts receivable. Let's go ahead and put in Health 1 just to clarify which account. An accounts receivable is an asset, and it's going to decrease because Health 1 no longer owes us this account balance. So we're going to credit that account. So when we collect the receivable, we're going to increase cash. We're going to increase cash for $80,000. And we're going to decrease accounts receivable so we're going to credit that asset account for $80,000. Okay. So on October 30th, we are going to declare and pay a $50,000 cash dividend to our stockholders. So since we've declared and paid, that means that we have paid the cash the minute we declared it. So which accounts are we going to affect? We're going to affect cash. Now take a minute to remember, dividends are paid out of cash, and so they're going to decrease our cash. So therefore our cash is our credit account. So because we declared a dividend, we now have a dividends account. Now we talked a little bit about dividends before in that they act like an expense, but they aren't an expense. But however, if we fit that into Alice, we know that to increase the dividends account is a debit entry. So that has to be our debit account. So let's show the journal entry for paying those dividends. Dividends is going to increase. It acts like an expense. It's not an expense, but it acts like one. Oh, sorry, and that was a $500,000 cash dividend. So our dividends account increased by $500,000, and our cash decreased by $500,000. Okay. So there's our journal entry. All right. So that is it for brief exercise 3.2. So let's go to work on brief exercise 3.3. So on January 18th, we are going to issue capital stock and we're going to do it in exchange for $400,000 cash. So we're going to start working through these pretty quick so that you can start seeing. So our cash account is going to increase by $400,000. And our capital stock account is going to increase by $400,000. Okay, so on January 22nd, we're going to borrow $100,000 from a bank, and we're going to issue a note payable. So we're going to be affecting cash, that's our debit account, and notes payable, which is our credit account. So let's do a journal entry. So on January 22nd, we increase our cash for $100,000, and we increase our liabilities in the form of notes payable also for $100,000. Okay. So January 23rd, we are going to pay $200 for a radio advertisement that aired on January 20th, or is going to air on January 24th. So let's think about this for a minute. We are going to pay cash for this ad. So our cash is going to be decreasing, so that's our credit account. So remember we talked about expenses? Expenses are goods and services that you use up in order to produce revenues. So radio advertisement is an expense. We are using it up to make sales. So we're going to have an advertising expense account. So according to Alice, to increase advertising expense makes it a debit account. So on January 23rd, we are going to debit advertising expense. We're going to debit it for $200. And we're going to credit cash for $200. Okay. So we've done an expense. Let's do a revenue. So on January 25th, we're going to provide $5,000 worth of services to clients for cash. So our first account we're going to be affecting is cash. We're getting some money for what we do for a living in our business. So providing those services in the form of cash is a revenue. So cash is going to be our debit account, and revenue is going to be our credit account. So let's record the journal entry. So on January 25th, we're going to get cash. And we're going to record that revenue. So remember the difference between an asset and revenue. revenues come in because we're in business and we're doing whatever the intent of our business is. If we're a clinic, we're providing healthcare services. If we're a bakery, we're providing baked goods. But you're bringing in money due to the nature of your business. So on January 26th, let's throw a little kink into the works here. We're going to provide $18,000 of services to clients on account. So what's our first account that we're going to affect? So remember, if we provide something on account, that means it's a credit account. So our clients owe us $18,000. So that's going to be an account receivable. So we're going to debit accounts receivable because it's an asset. So that's going to be our debit account. So we still record those revenues. It doesn't matter that we didn't get cash for those revenues. We're still going to record them. So we're going to recognize client service revenue. If we were on a cash basis, we wouldn't recognize it yet. But that doesn't matter in an accrual system in accounting, which is what we work in. So if we do the journal entry, we're going to debit accounts receivable for $18,000, and we're going to credit client service revenue. So remember our matching principle. We recognize revenues when they're earned, and we recognize expenses when they're incurred. So on January 31st, we have some clients that are going to pay off some of those accounts receivable. So we're going to collect $4,200 cash from clients for the services that we provided on January 26th. So we got some clients that are going to pay it. So on January, what's the first account that we're going to do? We're going to be dealing with. We're going to get cash. So that's going to be our debit account because our cash is going to increase because those credit accounts are being settled. So if they've paid us cash, they no longer owe us that money. So our accounts receivable are going to decrease. They're an asset, so that has to be our credit account. So on January 31st, we're going to debit cash for $4,200. And we're going to credit accounts receivable. Okay. So now, if we look at brief exercise 3.3 at the bottom, part B wants us to determine the balance in the cash account. On January 31st. So we need to do a running total of the accounts or the transactions that affected cash. So we're going to need to go back and look. So what we're essentially doing is posting to the cash ledger. So it's a little difficult to do that in Word, so we're going to have to make this look not quite as pretty. So let's just go back and look at our each individual transaction. So on January 18th, we debited cash for $400,000. So let's set it up this way. That'll be our debit side, and this will be our credit side. So we debited cash for $400,000. So I went a little too far. There we go. So on January 22nd, we had another cash debit for $100,000. So that takes care of 2 of our transactions. January 23rd, we had a credit cash for $200. So let's record that debit, or that credit. On January 25th, we had another debit to cash for $5,000. January 26th, we didn't affect cash at all. January 31st, we had another debit to cash. Didn't work out quite as neatly as I'd hoped, but we'll make it work. So what is the balance in our cash account? So let's just go back and double check. Did we spend cash anywhere else but that radio ad? Here we didn't spend any. January 22nd, we did not. There's our radio ad that we paid cash for. We received cash here, so we're good. No cash was affected on January 26th. And on January 31st, we collected cash, so we only had that one credit entry. So that means, if we think about this being divided in 2, oops, let's move this down so it's a little easier to see. So that was the end of our cash activities. So our debit total for cash would have been $400,000 plus $100,000, so $500,000. Plus 5,000, so 505, plus 4,200 gives us a total of 509,200. So the only credit that we had to cash was $200. So if this is our debit column, this is our credit column. Our debit column's bigger. So that means that our cash account is carrying a debit balance. And it has a debit balance of $509,000 even, because we're going to subtract that credit entry. Okay. All right, let's move on to brief exercise 3.5. So we're going to have some changes in retained earnings in 3.5. So on January 1st, the retained earnings account was $90,000. We are going to record revenue in January. And our revenue is going to be $500,000. And we are going to incur expenses of $260,000. So again, that was in January. And then we're going to pay dividends we're going to pay dividends of $15,000. Now, we are going to also pay a $35,000 account payable during the period. So, in January. So we need to know what our retained earnings balance on January 31st. Okay, so let's work through this. So we turn to the income statement, because remember the articulation of our financial statements says that net income feeds into retained earnings. So remember, net income is profit. Now, that's true unless dividends are paid. In which case, the dividends are paid out of that net income. And so dividends decrease retained earnings. So knowing that, we need to figure out what our net income is. So we know that we had revenues, and we had expenses. So if we subtract those, that's going to be our net income. So our revenues were $500,000. Our expenses were $260,000. So that gives us an overall net income of $240,000. So now what do we do with that accounts payable that we paid? $35,000. Our first instinct is that we paid an account payable. So if we did that, we did it in cash, so that would be subtracted from our net income. However, don't fall prey to that temptation. An account payable is a liability. So does that belong in the income statement? No, because income statement only carries revenues and expenses. We would record that accounts payable transaction in balance sheet accounts. It would be cash. Cash would decrease by $35,000, and accounts payable would decrease by $35,000. So we're going to ignore that $35,000 accounts payable payment in January. So right now, $240,000 is available to put into retained earnings. Now going back, we see that we paid $15,000 in dividends. So we know that dividends decrease retained earnings. So we need to subtract those. So that means $225,000 in net income is available to be moved into our retained earnings account. So we know our beginning balance on January 1st was $90,000. We're going to put in retained earnings for January. That was $225,000. So that means our ending balance on January 31st in our retained earnings account has to be $90,000 plus that $225,000. So that means our ending balance is $315,000. All right, that takes care of brief exercise 3.5. So let's move on to brief exercise. Let's go ahead and do brief exercise 3.4 just for completeness. And then I think we will call that a day. So in brief exercise 3.4, we have account classifications. And so hopefully this will just review everything that we've been doing and reinforce how to increase or decrease each account type. So we want to know for revenue, expenses, assets, liabilities, and owner's equity. How do we increase each account type? So we're going to refer back to Alice. Let's pretty this up a little bit. That didn't work. Let's just do this. There we go. Move this back a little bit. All right, there. That's a little easier to read. All right. So to increase a revenue account is a credit. To increase an expense account is a debit. To increase an asset account, again, is a debit. To increase liabilities is a credit entry, and to increase owner's equity is a credit entry. So how do we decrease each of those account types? So if we credit revenue to increase it, that means we have to debit it to decrease it. Expenses is a debit to increase, so a credit to decrease. Assets, a debit to increase and a credit to decrease. Liabilities, a credit to increase and a debit to decrease. And owner's equity, a credit to increase and a debit to decrease. So again, what brief exercise 3.4 does is just sums up Alice for us. So hopefully Alice is a quick way for you to take into account how to deal with each different account type. Okay, so that is chapter 3. And so in chapter 4, we are going to be doing some conversion of some of these things. So I want you to get a really good grip on how debits and credits work, which accounts get debited and credited to increase or decrease. And so I want you to spend a lot of time with Alice when you sit down to do your homework. So hopefully you found this an enlightening lecture, and I will look forward to seeing you next week on Monday. Talk to you later. Bye.